Imagine two loan payments for the exact same amount borrowed. One costs $300 a month, the other costs $450. Same loan, same principal, but one costs 50% more. The difference is the interest rate. Watch a simple slider move up, and the monthly bars grow taller. In this video, we'll explain what interest rates are, why they change, and why borrowing becomes more expensive when rates rise, using clean visuals, rate dials, payment bars, and money flow diagrams to make the idea clear and concrete. An interest rate is the price of borrowing money, shown as a percentage per year. When you borrow, you repay the amount you took plus interest, the lender's fee for letting you use their funds. Think of it like renting money. If a loan has a 4% annual rate, that rate is applied to the outstanding balance over the year and broken into monthly charges. On screen, a simple calculation shows $10,000 at 4% costing roughly $400 a year in interest, about $33 a month before principal payments. That percentage, the interest rate, is the core number that determines your monthly cost. Interest rates directly change monthly payments and total cost. For example, a 30-year mortgage of $300,000 at 3% produces a monthly payment around $1,265. Raise the rate to 6%, and the monthly payment jumps to about $1,799. Visually, the payment bars grow taller, and the total interest paid over 30 years increases dramatically. The same principal, different rates, very different cost. Side-by-side visuals show total interest paid over the loan term, and a timeline highlights how higher rates front-load more interest, meaning more of each payment goes to interest and less to reducing the principal early on. Higher rates mean each payment contains more interest. The principal you borrowed remains unchanged, but the cost to carry it rises. As charges increase, individuals delay or cancel purchases. Fewer home purchases, delayed car buying, smaller credit card balances. On-screen money flow diagrams slow down as the rate slider moves up. That reduced borrowing lowers household spending, which reduces business revenue. The visual sequence shows spending levels falling and monthly payment stacks growing, illustrating how higher rates propagate through many everyday financial choices. When consumers spend less, businesses adjust. Companies delay investment projects because loans for equipment or expansion become costlier. On screen, a planned factory or store icon pauses as the rate climbs. Firms facing higher borrowing costs may hire more slowly, put vacancies on hold, or trim hours. The animation shows hiring lines flattening after spending slows. This is a feedback loop. Less hiring reduces incomes, which further reduces spending, and the economy cools gradually as borrowing becomes more expensive for both households and firms. Central banks, like the Federal Reserve, intentionally change key policy rates to influence economic activity. When inflation is rising or the economy is overheating, they raise the policy rate. That pushes market rates higher, shown on screen as the central bank's dial nudging the global rate slider, which raises mortgage, loan, and credit rates. The transmission is visualized step by step. Policy rate change, bank lending rates adjust, consumer and business borrowing costs change. Spending responds. Conversely, lowering rates makes borrowing cheaper and tends to boost spending. This is not about prediction, it's a mechanism. Policymakers weigh trade-offs. Higher rates can slow inflation, but also slow growth and hiring, so changes are measured and gradual. A timeline graphic shows past rate moves and their delayed effects on spending and inflation. Interest rates are the cost of renting money. Small changes can meaningfully alter monthly payments, total interest paid, and the pace of spending across the economy. Higher rates make borrowing more expensive, slowing purchases and investment, which in turn cools economic activity and can help reduce inflation. The key idea: rates are a managed tool that helps control how fast money moves through the economy. The visuals, rate slider, payment bars, slowed money flow, summarize cause and effect in a clear, beginner-friendly way. Understanding interest rates clarifies why your payments and choices change over time. Watch the rate dial, and you'll see the effects on payments, spending, and the wider economy. Subscribe for simple explanations of how money works.